Welcome to Historic Financials, the channel where we break down the forces shaping wealth, power, and opportunity in the modern world. Today's exploration dives into three of the most misunderstood, most powerful investment arenas on the planet: farmland, water rights, and catastrophe bonds. While headlines obsess over tech stocks and inflation scares, there are deeper, slower moving financial currents that have transformed quiet assets into billion-dollar machines. And whether you want to protect your savings, diversify your portfolio, or simply understand how real wealth shifts behind the scenes, these markets reveal a very different picture of the future. For most of modern history, farmland was the ultimate boring asset. Stable, predictable, and slow. But the last few decades quietly turned agricultural land into one of the most profitable wealth engines on Earth. Between 1992 and 2022, it returned roughly 11% a year, and did it with less volatility than almost every major asset class. A growth rate that rivals real estate and nearly matches the S&P 500, but without the wild ups and downs. And while stocks plunged during major recessions, farmland not only held its value, in many cases it accelerated. The U.S. has roughly 900 million acres of farmland, and for generations, this land stayed in families. But tightening margins, rising taxes, aging farmers, and consolidation changed everything. Land ownership shifted. Hedge funds, large-scale agriculture companies, wealthy families, and institutional investors began buying at scale. Today, nearly 40% of American farmland is owned by people older than 65. That is an unprecedented concentration of land in the hands of a generation preparing to pass it down or sell it off. Over $5 trillion worth of farmland is almost certain to change ownership in the coming decade. That kind of shift doesn't just influence markets, it reshapes them. But demand is only one side of the story. The other is inflation protection. When the 1970s inflation storm hit the U.S. economy, almost everything got crushed except farmland. During that decade, U.S. farmland values increased more than 400%. Why? Because farmland produces the one thing inflation cannot devalue: essentials. Food, grain, fiber, protein. Inputs the world must consume regardless of economic cycles. That pattern repeats again and again. When inflation rises 1%, farmland historically moves almost 1% in the same direction, a near-perfect correlation. Meanwhile, it has almost zero correlation with stocks, bonds, crypto, or gold. In a world where portfolios are drowning in interconnected assets, farmland stands apart as something that has its own rhythm, its own supply constraints, and its own demand cycles. It's not glamorous, but it's one of the few assets that behaves like a financial island. Of course, farmland isn't uniform. You have row cropland, permanent cropland, and grazing land, each with different yields, risks, and scarcity dynamics. Row cropland produces staples like corn and soybeans, and though it's less volatile, its returns can vary with commodity prices. Permanent cropland, orchards, vines, long-lived fruit trees, often delivers higher returns but comes with higher upfront costs. Grazing land is cheaper but sensitive to drought and climate conditions. Across all three, one trend is impossible to ignore: the supply of farmland keeps shrinking while demand keeps climbing. In the early 20th century, America had over 1 billion acres of farmland. Today, that number has been steadily declining. Urban sprawl, land development, water scarcity, and shifts in crop economics have removed millions of acres from production. And as land grows scarcer, prices naturally rise, especially for the highest quality acreage. Even when commodity prices fall, the top-tier land rarely goes down. It's too valuable, too productive, too hard to replace. That scarcity, combined with inflation hedging, stable yields, generational turnover, and the raw necessity of food, is why farmland has become so attractive to big investors. And yet, the biggest factor shaping the future of agriculture isn't land alone, it's water. Now, we shift to an asset class that is almost invisible until you start studying its water rights. Most people never think about who owns the water flowing through rivers, aquifers, and irrigation channels. But in parts of the United States, especially the West, private ownership of water rights is one of the most important financial levers in the entire agricultural market. Without water, land is worthless. With water, marginal land becomes extraordinarily profitable. Unlike farmland, which has a national footprint, water rights are hyper-local. Their value can shift dramatically from one county to the next. Some water rights are tied directly to river systems. Others are connected to irrigation districts. Some have seniority dating back a century, meaning those rights get priority during droughts. The legal frameworks are complex, but the underlying economics are simple. Water is becoming the most constrained agricultural input in America. Drought cycles, hotter summers, shifting rainfall patterns, aquifer depletion, and explosive population growth in the Southwest have all collided. That collision is transforming water rights into one of the most sought after and contentious assets in modern finance. In regions where water is scarce, rights have climbed from hundreds of dollars per acre foot to tens of thousands. And in certain basins, the bidding wars are fierce. Farmers, cities, developers, utility districts, and corporate buyers all compete for the same limited resource. The result: in some areas, water rights have grown more valuable than the farmland itself. But water rights aren't just valuable for farming. They also act as an inflation hedge, because as the cost of living rises and cities expand, the price of water tends to follow. Supply is fixed. Demand only increases. From a portfolio perspective, water rights behave like a hard asset, but one that produces cash flow through leases, transfers, or municipal contracts. This brings us to the final major asset class, catastrophe bonds, or cat bonds. If farmland protects against inflation and water rights guard against scarcity, cat bonds defend against the unexpected. These instruments form a bridge between insurance companies and global capital. In simple terms, an insurance company facing huge potential losses from natural disasters, hurricanes, earthquakes, wildfires, and more can transfer that risk to investors through a cat bond. If the catastrophe doesn't reach a specified threshold, investors earn steady, high yields. If it does, their investment is partially or fully wiped out to cover the insurance losses. The global cat bond market is now valued at over $100 billion, and it's growing faster than almost any other segment of insurance finance. Why? Because natural disasters are becoming more frequent, more destructive, and more expensive. Traditional insurers struggle to absorb the rising risk, and reinsurance companies can only take on so much. Cat bonds solve that limit by tapping global investment capital, essentially crowd-sourcing catastrophe risk. For investors seeking returns uncorrelated with stocks and bonds, cat bonds have become almost irresistible. They behave independently of interest rates, corporate earnings, and macroeconomic cycles. When markets crash, cat bonds often move sideways. When inflation rises, cat bonds don't necessarily follow. Their only major correlation is with the frequency and magnitude of natural disasters. In today's market, yields often range between 6% and 15%. Some issues exceed 20% depending on the risk severity. And unlike farmland or water rights, cat bonds are fully liquid, tradable instruments. You don't need tens of thousands of dollars or regional expertise to participate. But they require discipline. A single catastrophic event can erase years of gains, and modeling climate risk is notoriously difficult. Yet the interest continues to surge because institutions want diversification. And cat bonds offer something rare: high returns without equity market exposure. When you step back and look at these three asset classes, farmland, water rights, and catastrophe bonds, a pattern emerges. Each asset is tied not to consumer preferences or market cycles, but to fundamental forces: food, water, weather. These aren't trends. They are the scaffolding of civilization. Assets like these behave differently because they exist outside the financial narratives dominating the news cycle. Stocks crash, currencies weaken, supply chains break, inflation surges. But even through all of that, people need to eat, cities need water, and disasters need insurance coverage. That's why the wealthiest investors, from legacy families to major institutions, are increasingly allocating to these overlooked corners of the economy. They're not chasing hype. They're buying resilience. They're buying scarcity. They're buying assets that remain valuable regardless of political shifts, fiscal policy mistakes, or speculative bubbles. As the next decade unfolds, farmland will likely keep consolidating into larger operators. Water rights will continue climbing in price as scarcity deepens. And catastrophe bonds will expand as insurers look for ways to survive increasingly unpredictable weather. These aren't short-term plays. They are long arcs, slow, powerful, transformative. And that's the real story in a world obsessed with fast-moving markets. The most reliable opportunities may be the ones rooted in essentials, the assets shaping the survival and stability of entire societies.